made you co-host, Robbie, so you can share to the screen if you want. So,
All right, so let me start this, and I'm gonna share my screen. Mhm.
all right. See, it's 12:01. All right. Good morning or good afternoon, everybody. As we talked about right at the noon hour. Typically, we do this a little bit earlier. But we have Rabbi Shamis back with us again from Movement Mortgage, our smart partner. Last time we talked about 3 different programs they had. It was pretty fantastic. So, Robbie, why don't you take it away today for our agents? I want to pin you up there for everybody.
All right, I appreciate you. Thank you for giving me this opportunity to empower people with knowledge. So what I want to talk about today is one of the 3 topics we mentioned yesterday. I want to go a little bit deeper into how buying down interest rate could help buyers today and sellers. When we are thinking about the market today, I believe is it is a very healthy market for buyers. When we are looking at national news, we are noticing that the south part of this country is having some adjustment or price softening for the real estate price. And when we are looking at that information, what does that mean, and how could we help our sellers and buyers take advantage of this opportunity? I don't see softening market as a bad thing. I see it as an opportunity for people that understand this as an opportunity, because there are 2 type of people. Some of them will buy real estate today and they will be happy they did a few years later, and some of them will wish that they did today. So is renting better than buying? Those are questions that I'm hearing a lot from the consumer, from potential home buyers. Are house prices going down or up? Will interest rate drop September 2025, because this is when the Feds are going to meet again? And how would that affect our industry? There's a lot of real estate agents today are waiting for interest rate to drop. They are waiting for the real estate to improve. They want something to change. But in reality, there is between 7,000 to 9,000 homes were sold in Houston by itself last month. The business is out there. How many transactions do you need to thrive in this business? 3, 4, 5 closings per month. They are out there. So when we're talking about rent versus own, if you don't believe that owning is a gain, you're not going to be able to convince the renter that owning is a gain. When we talk about today's market, we need to bring up the subject of building equity. In reality, having a mortgage payment today is more expensive than paying rent. We're not going to sugarcoat this reality, but we're just going to shine the light on the equity that the homeowners gain, where the tenant doesn't. So the gain is about 5% per year or 4% per year. So if someone is buying a home for $400,000, they are going to gain a $20,000 in equity in a 12 months period. Sometimes I ask them a question: if your employer comes to you and tells you, "I'm going to cut your income by 20,000," how would you feel about it? You're not going to be happy. So why are you cutting your income by 20,000 by renting? So I educate them about the other side of what happens when we own real estate, because it's obvious rent is cheaper, but they don't see the future themselves and the equity they built. So the objectives that we are hearing today
Hey,
is
Robbie.
mainly, go ahead, Marty.
On that too, oftentimes when you're talking to buyer clients that are on the fence between renting and buying, that's a very good example about appreciation. You can say, can you, as a renter, put away that amount of money per month to save $20,000 in a year to make up the difference of how much that house is going to cost next year? And generally, you can't. The idea is you have to ride the wave of appreciation by being in real estate. Move up. Yep.
Yeah, no, I agree. So the number one objective I'm hearing today, it's a very valid objective, which is affordability. In reality, the inflation is here. But though when someone is telling me I'm waiting for something in the market to change, let's look at the data. I'm looking at the last, from 1985 to 2025, where has interest rate been? And today we are around, like, if we look 20 years back, in 2025, I mean, in 2005, interest rate were about 5.8. We can get 5.8 today. We're hovering around that number. So if we call people that bought a house in 2005 and we ask them, do you regret buying that house at a higher interest rate? Of course not. The answer is here. So when we're looking at how often does real estate crash, how often has it happened? Not that often. The only time that we have seen a real estate crash in the history of the United States is in 2007. So, and that was before, because there is a lot of different data. The data that existed at that time doesn't exist today. So when we have a buyer that is scared to buy today because they might lose a lot of equity, we need to educate them about what a crash means, and there is demand versus supply, and it doesn't happen as often. And if we're waiting for this to happen, it's like waiting for the Apple stock to drop to $1 for us to get into the stock market, or buying Bitcoin for $1 where it's 100,000 today. So it's the same thing, and we want to educate them about it. We want to be the source of the information. Make sense? All right. So let's face it, affordability is the biggest issue. A lot of people can't afford going to HEB anymore. They go to Aldi, they go to Costco. So we need to address the obvious. And this is where the buy down comes very handy. And the buy down is a way for a borrower to obtain a lower interest rate and payment, either permanently or temporary, by paying a desired one-time amount upfront at closing. When someone tells me, my brother got a 6% interest rate, and I ask them, how much points did they pay? They don't know. Unfortunately, the buy down is something that is in the fees. They have a statement with a lot of different, on the loan estimate, there is a lot of different numbers. It's just one of them. They don't pay attention to it. It has been used for a very long time. It has a good purpose over there. And let's see how we can use this tool to improve the affordability of our clients and help them get into a home that is under their budget. Like sometimes a client tells me, my rent is $2,700. I want to get into a house for $2,700, and I want to buy a home for $300,000 or $350,000. Could we do that without him paying 20, 30, 40% down? Yes, we can. And this is where we can talk about it.
Hey, Robert, a quick question for you on this. I mean, you may not know, we may have to talk to an accountant on this, or our tax preparer, if you will. Because oftentimes loan costs to purchase a house, obviously the mortgage interest is deductible, but oftentimes the cost to acquire the house can be a deduction off your taxes as well. Is a buy down included in that?
Yeah, so the discount points are included in the deduction. Again, it depends on their tax situation, but yes, I mean, there's no loss in it on the long run. The difference between a temporary buy down and a permanent buy down. The temporary buy down, as it says, is temporary. It's 1 year, 2 years, or 3 years. So for the first 1 or 2 or 3 years, their interest rate is lower. On the permanent, they are taking this loan, let's say for 30 years. Their interest rate, whatever they paid up front to lower that rate, it is permanent. It doesn't change. So that's the big difference between them. I personally always prefer the temporary buy down, and I'm going to explain why. And I don't want you to get confused between the ARM loan, ARM interest rate, and the temporary buy down. This is not an adjustable interest rate. This is not a rate that starts at 6 and then it goes to 9. It doesn't. Everything is known up front on the temporary buy down, where on the adjustable rate, there is a lot of unknown because we don't know the ceiling. A lot of people are scared of the ARM, so that's why I wanted to bring it up. So the pros and cons of a temporary buy down. The temporary buy down will have a big impact on the monthly payment. So when I am using, for example, on a $300,000 home, if I have about $10,000 from the seller, I could use that $10,000 to drop their interest rate from, let's say, 6.9 to probably 3.9. It's a major improvement to their monthly payment. It is making an impact of about $400 to $600 a month. So this is the main reason why I love this program. The second reason is unused funds are returned to the buyer. So basically, when we bring $10,000 from the seller, we are putting it into an escrow account. I'm going to show you this. So we are putting this money, the $10,000, into an escrow account. Other than the escrow account that goes for the property tax and insurance, every month, automatically, there will be an amount of money withdrawn from this escrow account towards their monthly payment. Let's say a year from today, and let's say we did a 3-year temporary buy down. A year from today, interest rate dropped to 4.9 or 5%. And it's time for this buyer to take advantage and refinance their loan. On a temporary buy down, because we're paying off the existing loan when we refinance, that money belongs to them. It's an escrow account, same as the escrow for the taxes. It will go to them after closing. Versus when we are dealing with a permanent buy down, this money is paid to the bank up front and they don't get it back. So this is one big major reason I like this program more. Normally, the seller has to pay for that. The buyers are not allowed to pay for the temporary buy down. So it has to be a negotiation in the price. Hey, Mr. Buyer, instead of offering $400, let's over $415 and use that $15,000 towards temporary buy down. So that's a way to do it. There's an immediate cash flow because it has a major impact. So if I want to use $10,000 on a permanent buy down, the rate will drop maybe by 0.5%. Their monthly payment drop by $75 to $100. Where on the temporary buy down, their payment is dropping by $500, $600 in some cases. So it's a major impact on their monthly payment. And reduce a price reduction. So we want to help the industry to maintain our prices. We don't want to keep dropping the price every time the house doesn't sell. There is a way to maintain the prices by offering things like the temporary buy down and having seller concession to cover it. Bottom line, the seller will net the same. The buyer is getting lower payment. It's a win-win situation the way I see it. That's why I call it a lower cost to seller, because in order for the seller to drop the price to give a buyer a $600 improvement in their monthly payment, they have to drop the price by maybe $100,000. So it's a lot of money that we are saving the seller and we are making the buyer happy at the same time. And the cons. So the buyer cannot qualify for a lower start rate. So if we're dealing with DTI, we have to use the highest interest rate on the temporary buy down when we are approving the loan. The relief is temporary, or the cons. So it's a 1 year. First year, the interest rate is 3.9. Second year is 4.9, and then 5.9, and then 6.9. So their payment will start by, let's say, 27. It goes up to 29. It goes up to 31. So they need to know that ahead of time. I educate them about it. Our disclosures talk about it. Our closing, we talk about it. They should be aware of it. But a lot of times people forget. They forget that their monthly payment is going to go up. They don't have the budget for it. So that's the cons for it. And also when the interest rate drops, so let's say they are at 3.9 today, but the starting rate is 6.9. So if the market drops to 5, we're going to refinance that client because it's a temporary. But again, there is money in the escrow that goes to them and that will cover their closing costs. So this is a good win-win for them. Questions so far about the temporary buy down? All right. So the permanent buy down, again, this is one you are.
I think Winston raised his hand.
Yeah, can you please go a little deeper on why the buyer needs to refinance if the rates drop? Why is that?
Okay, so when we are locking the rate for a temporary buy down, we're locking the rate at 6.99, and we're using the money that we got from the seller, which is right here, and we are applying that money to the payment to reduce their monthly payment. So in reality, their rate is locked at 6.99. Their payment is calculated based on 3.9, 4.9 the next second year. So when market improves, I don't want them to end up at 6.99 2 years later. So it will be a better time to maybe refinance them when interest rate drops. And this is what I mean by that.
Yeah, basically, you don't have to, but it's a good idea to refinance at that point in time. Yep.
Correct.
Okay, so it's recommended, not is required. Okay.
No requirement.
Okay.
There's no
got it.
prepayment. There is nothing different about this loan program except how we are reducing the monthly payment. So mainly that's what it is.
Gotcha. Thank you.
Got Gail raised her hand.
Yes, on the next slide that you did after this one, yes, it says the buyer. No, I can't see but anyway,
So it's this one.
yes, that one. No, it was the one where it was a win-win if the seller paid the funds to the. No,
Okay.
You're talking about instead of lowering the sales price, the
Right.
seller-
Yeah.
yeah.
yes. So how does number 3 and that one reduce price reduction? I totally did not catch that.
There will be a slide. We'll talk about it.
But because it says lower cost to the seller.
Correct.
Uh,
So
Just
if you
for-
want, let me jump into that slide really quickly to answer you, and then we can go back. So this is someone that is purchasing, I think this is the one. Here it is. This is an example where someone is listing a home for 400,000, for example,
right.
and they decided, hey, the price is not dropping. I want to I don't have buyers, so I want to drop the price to 385. By doing this, the buyer is getting a market interest rate of 6.99. There is no money coming from the seller to help the buyer reduce their monthly payment.
Right.
And at the end, we are looking at the total payment for this client, including tax, insurance, and all that, $33.54. What if this buyer gave $400,000 to the seller and asked the seller to pay $15,000 to reduce the payment? So the impact is $548 a month. It's a major impact. In order for the seller to meet a reduction of price of $548 for the buyer, they have to drop the purchase price way below $350.
So
And
what
I
you're
think I
saying,
have a slide.
Robbie, is basically the seller can choose to lower the price to attract more buyers, or they can attract a larger group of buyers by offering to pay down their rate, because more buyers can afford $2,700 versus $3,500.
So this is a better example of this. So
Got
we have a 700,000, and we are using seller buy down. So we're dropping the rate to make a monthly payment of 3,454 in this example. If affordability is the problem and the monthly payment is our target, if the seller wants to give the same monthly payment of 3,454, that means their purchase price has to drop to 607. It is a $92,000 drop. So we are satisfying the need of a buyer to give them lower monthly payment without having to have the seller lose a lot of their equity, because we are marketing the property differently.
Hey, Robbie,
I got it.
wouldn't this be a great thing for a buyer's agent too? Hey, we're making an offer on this property. We're talking to a lender.
That's what I was. Yeah, that's what
So
I was.
buyer's agents win, the sellers win. I think as long as everyone is aware of what we're talking about. Because
Yeah,
I've seen some pushback just because they don't know what we're talking about. Okay.
got it.
Masheed has a
you.
question. Masheed, go ahead. Are you there, Masheed? Mahid? I mispronouncing your name wrong. Emmanuel.
Correct.
There we go.
Got it.
There we go. Okay.
Two questions. The buy down. You're saying that if the seller will reduce the price, so in other words, if reduces the price and you pay as a buyer to the seller the full amount, right?
Mm-hmm.
And then the difference, the seller will put it in the account for you to reduce your payments or whatever, to create a financial backup for yourself.
Mm-hmm.
What is the difference between this and if you have money, you negotiate as a buyer with seller, and instead of sellers giving you the money, you pay, you get a better deal, and the difference between the full amount and
Mhm.
the actual sales amount will be yours. It's yours. You can put it in a savings account, CD account, everything account, and get interest on it and hold it
Mhm.
for the future payment of the interest. What is the difference between this and what you're describing?
So when we are using a temporary buy down, the seller is the only one that can bring the money towards that equation, that financial equation. What you're telling me is, what if my buyer is smart with his money, he's disciplined to put it in a retirement account, he's gonna get high yield,
Yeah.
and what if he has extra money? So again, every client is different. If someone with high net worth, maybe they're not concerned about monthly payment to be under 3,000. So the situation is different. But I would say 90% of the consumers today are driven by, can I afford this monthly payment or not? Right?
That is very true, because buying house is much riskier than renting house at this
Right.
moment of the economy.
Right.
Therefore, if one wants to buy a house, needs to have a very solid financial statement to commit for that. Otherwise, even the banks will not give them the loan to commit for the buy of the house. Anyway, my second question is that
Mhm.
how much the difference between how much the difference of the interest rate shall be for someone to refinance, meaning that if the present interest rate is 6%, how much the 6% should drop down for me to refinance my house?
I usually don't drive the conversation by percentage, because the currency we use is dollar, not percentage. So normally it has to make sense by the dollar amount, not a percentage amount. I use a software that tells the client, based on your interest rate and based on the market, this is a good time to refinance or not. But usually there is a calculation that I do. I take the cost of the loan, how much am I saving per month, and I divide this by that. If it's less than 2 years, that means it's a good win. If it's going to take 4 or 5 years to break even, it is not a good time to refinance. And then another question is how long you're keeping this home for. So this is how I usually help my client decide if this is a good time to refinance or not by percentage.
Because I heard, or I know, that at least if someone in the past they purchased the property, at least they have to stay there for 5 years to create an equity to resell that. You cannot buy it and sell it next year, and that is a loss.
Right.
Anyway, so you're saying that you have a software that calculates that for you. Thank you.
Correct. Yeah. And this software is also open for real estate agents to
Right.
be on it.
Thank you.
Robbie, as well, and for us as agents, oftentimes a seller will ask us about net proceeds. Think about that for a second, right? We have to understand that there is an average appreciation in the Houston area around 5% a year, as Robbie's saying, increase. The 5-year mark could be different. It could be a year where you gain 10%. Do they have enough equity to pay for the cost to sell the home, which includes commissions, taxes to sell, anything like that. So that also is part of our sort of mathing, and maybe a year or 2 years or 5 years, depending on which market we're in. So, all right, Dad, you're next.
Yes, sir. Thanks, Marty. Robbie, just a quick, I'm going to make it real quick. So in going back and having a seller gain essentially what the seller wanted, for the list price, right? I think he showed an example of the 600,000 or maybe 675. But in any case, if the seller, that's either one. If the seller is going to gain the amount that the list price that the seller wanted, and the seller is contemplating that buy down, then it's imperative for the agent I mean, obviously, we're not appraisers, but it's imperative for the agent to be able to manage the CMA, to be able to get an understanding of, okay, if we list it as 600, I think the market can appraise for 625. So that takes a little understanding for that particular agent in advising the seller that, hey, we can be in the ballpark, if we're doing a temporary buy down, right, Robbie? Is that what we're saying?
Oh yeah, correct. In my opinion, every offer needs to be supported by a CMA. I'm a data-driven person, so when someone comes to me and gives me an offer that emotionally offends me, but then shows me data that shows there is a support for the offer, I will be more open to accept it. And this is how I would approach the situation. So to succeed in this transaction, there is education for the buyer. There is also how you structure your offer. And the third part is it going to appraise so we can get $15,000, $20,000 from the seller? You're totally correct, Emmanuel.
All right, carry on there, Robbie.
All right. So let me see. I think we covered a lot of that. I want to cover how much contribution can you get from the seller. So it varies on a conventional loan based on the down payment. It can go between 3%, 6%, and 9%. So basically, if someone is putting 3 to 10% down, they can ask for 3% down payment. If someone is putting more down, then they can go up with that. On an investment property, it is capped at 2%. So if someone buying a rental. On FHA, it is at 6%, VA 4%, and USDA 6% is their max. And it's a lot more than we need. So we don't need 6%. Give me 3% and I will do magic with it for your client. This is how I look at it. So the different type of buy down. There is a 1-0 buy down, there is a 2-1 buy down, and there is 3-1 buy down. So if you cannot negotiate $10,000 and you're only able to get me $4,000, I'll work with it. I will put them into 1-year buy down. You get me more, I will put them into 2-year buy down. So this is the first year, the rate will be 1% lower than today's market. And then after 1 year, it goes up. The second one, 2 years. So the rate will be 2% lower in the first year, 1% lower second year, and then it goes up. And the third one is 3% lower than the market, and then 2, and then 1. What I was to also share with you is where are we heading with interest rate? So a lot of times this conversation goes with where we are heading with interest rate. People are waiting for interest rate to drop. What if I bring you the future of the rate today, and then when times comes later on, we could adjust your monthly payment, refinance your rate, then you get more equity in your home. You stop wasting money on rent. So again, all this knowledge are things we know. We assume that the clients know these things, but they don't. They have fear, and their fear sometimes take control of them, and they cannot function. It is our job to make sure they are educated. When I'm looking at projection of interest rate, there are Fannie Mae, Freddie Mac, and big companies that do projections for the next year and 2 years. We don't think rates will be less than 6%. If it drops, it's going to drop maybe 5.5%. Is it going to be a major impact to make a lot more buyers come and buy? I don't think so. Like, I think people think that they're buying a mortgage, but they're not. They're buying a home. They're buying a bigger kitchen. They're buying an additional room. They need the mortgage as a tool to finance the property, but they have misconception about. They get themselves confused sometimes. They think like they're day trading. That's how I feel like some homeowners are trying to do. So interest rate probably will drop a little bit in September, but it is not going to be a major impact. What we have seen from the beginning of the year is a drop in interest rate. Since January till today, it has dropped by about 0.5%. And again, with tools like this, we can demonstrate to the clients that we can get your house at a better price. We can get your house at a good payment. You want down payment assistance? We got it. So whatever their fear is, we need to listen and understand. And then once we understand their concern, we can come up with a solution and we can make a transaction happen. I think I covered all the details, and those are sample scripts for buyers.
Hey, Robbie, on that note on sample scripts, is there a chance for, let's say that I have a buyer and they're looking at a property they really want to make an offer on? Would it make sense to call you or one of the other smart partner lenders and saying, hey, here's their situation. You know, obviously they're pre-qualified or whatever. What's the best way to go about this? Is a buy down an option for them?
I love the fact that you brought this up because I cannot express enough how important it is to work with your lender in today's market. This is a numbers game, and we are the numbers people. It makes sense to bring us in this conversation. I ask every buyer putting an offer, every realtor putting an offer to talk to me about it. If they understand their monthly payment, they understand how much cash they need, and we can present it to the seller in a logical, realistic way, backed up by data, then you have a winner. So 100%. And if you felt like you had leads before that were off the fence, they were on fence, like they didn't want to buy at that time, it is a good time to call them and just say, hey, you know, the market shifted. Have you seen what's going on? They don't know, but the market did shift. This is a way to ask the client, are you open to a plan that will lower your interest rate and increase your purchasing power? And increasing the purchasing power happens when we are using the permanent buy down, by the way. So I have a client that could qualify for $350. He got under contract for $375. I used about $12,000 from the seller, dropped his interest rate to 6%, and I qualified him based on that.
Hey, Rabbi, can I ask you something?
Yeah, of course.
So do you have any product that comes with free refinancing after a few years?
So a lot of us lenders and mortgage companies, they are promoting, we will pay for your closing cost if you refinance with us in 2 years from today. I want you to know it's all built into their rate. It's all built into the numbers. I wish there is anything free. I don't believe it. Yeah, but we offer the same thing, but I don't think it's a purely free. I don't think so.
And what is the difference with the loan modification? Like, because that from what I've heard is way cheaper, right?
Correct. But the loan modification happens when someone has a hardship. Hardship means they lost their job. There is a reason why they couldn't make their payment. It's almost like the bank doesn't want to foreclose on them. They want to see if there is a way to help them keep the house and maintain their lifestyle.
Yeah, what can you
For the
offer?
ITIN,
Yeah,
Yeah.
there we go.
so ITIN, we are able to do them. They require about 10 to 15% down payment, but we do them all day long.
Okay.
Same script for the seller. So if the sellers are looking to drop the price, I beg you, please have that conversation with them. Let's not keep dropping price because I don't think it's working. I think we need to advertise what builders do, 3.99 interest rate, instead of dropping $15,000 in purchase price.
This is a strategy. I love this because a lot of calls we get to the broker line is, hey, my listing's been on the market for a month or 2 months. You know, I've done open houses. I've done marketing. We've dropped the price. What else can we do? Here's another option that you might be able to say, hey, here's something that maybe attracts more buyers.
Exactly. Other than this program we talked about last time is 100% financing, but I would say we are true partners, and true partners mean when you need to move something to sell it, let us work together. I think together we can make things happen. Second opinion sometimes matter.
Hey, Robbie, this is one more thing on that note too. I know that in the past I've worked with many different lenders, but I had the greatest success when I could call up and say, let's strategize. What do you need on the loan side to make this deal done? Whatever your closing costs, whether it be a certain term or whatever it may be. And then we're working with the buyer as a team to get the deal done. But on top of that, I've had the lender actually call the listing broker and tell them how strong my buyer client is. And it works great when you're on the same page.
Definitely. Yeah. Everyone has stress and emotions when it comes to, am I picking the right offer? Is this going to go through? So when you're calling me, when you're putting the offer, I am proactive about it. So I'm talking to your buyer. I'm talking to the listing agent. We want to make sure the seller understand what we're doing. Again, this is all about numbers, and it's a little bit unique financial strategy. We are here to help you. I don't want you to feel like you have to explain these things. No, we will. Just include us. I always feel like when we are talking to the listing agent, we're making them comfortable that everything is going to go through. The fact that we're calling them make a big plus, by the way. So if you would like a one-on-one strategy, if you need help into specific transactions, if you want our support, this is a QR code you can scan, schedule a strategy meeting with me. It is me, Dustin, and Christina here at Movement Mortgage that's here to support you. Any questions?
Go ahead and unmute yourself if you have any questions. Robbie? There we go. Robbie, can you put that one, after this is done, and after everybody's got a chance to take a picture of your QR code, is put the one up about the amount of concessions a buyer can receive, 6%, 3%, that kind of stuff. I'd like to get a picture of that.
All right.
It says your Calendly is not working, so probably means you're full. But
No, I think I did something with it, but I'll share it with you, Marty.
Okay.
Okay.
Sure, and I'll send it out for everybody. Yep. There we go. Thank you. That's what I wanted.
Mhm.
Cool. Any other questions, everybody?
Got it.
If not, I'll stop the recording then, so we don't waste people's time watching the